Price bounces inside the trap, but it cannot escape the old box. The session forms inside compressed memory. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. When price moves near those areas, a 1-hour bounce can look strong and still fail. A short can look obvious and still return. A long can work, but only if the memory holds. A short can work, but only if the recovery fails. That is why the session line matters. Now look at June 8th Asia session. June 8th Asia session forms inside June 8th US session box. It compresses by about 50%. It overlaps. That matters. A compressed box creates faster decision pressure. Price has less space to hide. Reaction comes sooner. Continuation fails earlier. The box does not give freedom. It gives a test. June 8th Asia session first moves lower. It reaches June 4th US session lower boundary. It tests that old memory. Then price moves up. It reaches June 8th Asia session midpoint. It tests the middle. Then price falls again. It returns to June 4th US session lower boundary. The movement is not random. It is a rotation between old lower memory and the compressed midpoint. Lower memory holds. Midpoint reacts. Lower memory gets tested again. That is the structure. Now we build the first trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price bounce. They want to buy. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve action. So the long starts with risk. June 8th Asia long setup. Entry line. June 4th US session lower boundary. Stop loss line. June 7th Asia session lower boundary. Take profit line. June 8th Asia session midpoint. Risk-reward ratio. 1.82. The entry sits at June 4th US session lower boundary. Why there? Because the market is still working inside old memory. June 8th Asia is compressed, but the real lower reaction comes from June 4th US memory. If price reaches June 4th US lower boundary and fails to hold, the long has no base. If price reaches that lower boundary and reacts upward, the long can form. The entry is not the green candle. The entry is the hold. Price reaches the lower boundary. It reacts. It does not break lower. Distance starts to open upward. Then the long becomes active. The stop sits at June 7th Asia session lower boundary. That stop protects the structure. The long depends on June 4th US lower memory holding. But if price loses the June 7th Asia lower boundary, the recovery has fallen too deep. The bounce no longer has clean control. The position no longer has protection. So that line becomes the failure line. If price touches it, the long is not the same trade anymore. Leave. No hope. No argument. No waiting for another candle. The target sits at June 8th Asia session midpoint. That target is not aggressive. It is realistic. Price is not yet in a clean trend. It is rotating inside compressed memory. The midpoint is the first place where price can stall. The midpoint is the first place where buyers must prove they can push further. So the target belongs there. Risk-reward ratio. 1.82. That is tradable. but it is not big enough for sloppy execution. If the trader enters late after price already moves toward the midpoint, the ratio weakens. If the trader widens the stop below June 7th Asia lower boundary, the ratio weakens. If the trader ignores the midpoint and expects a full breakout, the trade becomes hope. So the long must be taken at the lower memory, not in the middle, not near the target. Now price reaches the midpoint. It reacts. It cannot build clean continuation. Distance starts to shrink. Bodies become smaller. Pullbacks deepen. Reaction comes back faster. The same level now changes role. June 8th Asia midpoint was the long target. After price reaches it and cannot stay, it becomes the short entry. That is why session memory matters. The target can become the next entry, but only after failure. Now the additional short setup appears. Short entry line. June 8th, Asia session midpoint. Stop loss line. June 8th, U.S. session upper boundary. Take profit line. June 4th, U.S. session lower boundary. Risk-reward ratio 1.82. The short does not come from guessing the top. It comes from failed continuation at the midpoint. Price reaches the midpoint. It tries to stay. It cannot. Reaction speeds up. Distance becomes shorter. The move returns lower. Now the midpoint becomes a sell decision. The stop sits at June 8th U.S. session upper boundary. Why there? Because the short is based on the midpoint failing. If price recovers above the June 8th U.S. upper boundary, the failure is no longer clean. The compressed structure has been reclaimed. The short has lost control. So the stop belongs there. The target returns to June 4th U.S. lower boundary. That is the same old lower memory. The long used that level as entry. The short uses that level as target. Same box. Opposite trade. That is how rotation works. Long from lower memory. Short from midpoint failure. Both setups carry the same risk-reward ratio, 1.82. That is important. The market is not giving a free trend. It is giving a controlled rotation. The trader must not get attached to direction. Direction changes. Structure decides. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The trade pays. But compressed boxes can whip. A wick can touch the stop. Reaction can remove the position. Then price can still move in the planned direction. The idea was right. The position is gone. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. But if the wider stop destroys the reward, no trade becomes the conservative answer. Here, both setups give 1.82, so they can be studied, but only if entry stays close to the line. Now, management. If price reaches the target, protect. Do not assume the next move. The box is still controlling the trade. If the long reaches the midpoint and stalls, take the result. If the short reaches June 4th U.S. lower boundary and reaction appears, protect the result. A trail needs to be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the position. If the stop stays too far behind, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last candle. Partial profit can help. If price reaches the first target and reaction gets faster, a conservative trader protects more first. 60% first. 40% left for continuation. If price holds and distance keeps growing, an aggressive trader can leave more open. 40% first, 60% for continuation. If the move reaches multiple stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create edge. The edge comes from the line. The edge comes from lower memory holding. The edge comes from midpoint failure. June 8th, Asia gives the first message. The market bounces. Then it fails. Then it returns. The same box gives both trades. Long from lower memory. Short from midpoint failure. Price reaches. It reacts. It holds or fails. Then the trader acts. Price returns to lower memory. But the bounce still needs proof. The session forms inside compressed overlap. Before reading June 9th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market already tested lower areas. The bounce can appear. But a bounce does not erase the larger field. A recovery can move up. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 9th U.S. session. June 9th U.S. session forms between June 4th U.S. session lower boundary and June 5th U.S. session upper boundary. It compresses and overlaps there. That matters. This is not a fresh open space. It forms where two old memories meet. June 4th U.S. lower boundary. June 5th U.S. upper boundary. That overlap creates a decision area. Price has to decide whether lower memory can hold again. The session forms at the boundary of old support and old resistance. That kind of location can create fast reaction, but it can also create traps. The session moves lower first. It tests June 5th basis box lower boundary. That is lower memory. Then price moves up. It tests June 9th basis box lower boundary. The move does not break free. It returns from lower memory into the new box. The structure is a lower bounce, not a clean breakout. That difference matters. Now build the long setup in the correct order. Stop line first, entry line second, target line third. June 9th U.S. long setup, entry line. June 5th U.S. session lower boundary, stop loss line. February 5th key low, take profit line. June 9th U.S. session lower boundary. Risk-reward ratio, 1.66. The entry sits at June 5th U.S. session lower boundary. Why there? Because price tested lower memory and reacted. The long is not chasing a sudden green candle. The long uses old lower memory as the base. If June 5th U.S. lower boundary holds, the bounce can move back toward June 9th U.S. lower boundary. If that lower memory fails, the trade loses control. The entry must happen near the lower memory, not after the bounce already runs. If entry is late, the ratio disappears. The stop sits at February 5th key low. That stop is important. The February 5th key low is not just another line. It is a major higher time frame memory. The weekly map already marked it. The market already reacted around it. If price loses that key low, the long is damaged at a larger level. The bounce is no longer only a 1-hour problem. It becomes a higher time frame failure. So the stop belongs there. A tighter stop may improve the ratio, but it may not protect the real idea. If price dips below the minor session line and holds above the key low, the long may still be alive. But if price loses the February 5th key low, the long no longer has a base. That is why the stop sits there. The target sits at June 9th U.S. session lower boundary. That may sound conservative, but the move is still a lower bounce. The market is not yet free. The target is the first return into the new session structure. Price must reclaim that lower boundary before it can do anything more. So the target is not the top of the box. The first target is the line price must recover. June 9th, U.S. lower boundary. Risk-reward ratio, 1.66. That is acceptable, but not generous. The trade needs clean execution. Entry must stay near June 5th U.S. lower boundary. Stop must stay connected to the February 5th key low. Target must be respected. If price reaches the target and stalls, take the result. Do not turn a lower bounce into a trend idea without proof. Now watch the behavior. Price moves down. It tests the lower side. It reacts. Then it moves back toward June 9th U.S. lower boundary. But the bounce is not free. Bodies remain controlled. Distance stays limited. Reaction can come back quickly. The market is still below larger pressure, so the trader must manage the position fast. The long is not a prediction of full reversal. It is a trade from lower memory to the first reclaim line. That is all. If price reclaims June 9th U.S. lower boundary and holds above it, a new structure can form later. But until that happens, the trade is limited. That is how we avoid chasing. Now compare June 8th and June 9th. June 8th Asia gave rotation inside old June 4th U.S. memory. Long from lower memory. Short from midpoint failure. June 9th U.S. gives a lower bounce from June 5th U.S. lower boundary. Stop at February 5th key low. Target at June 9th U.S. lower boundary. The structure is smaller. The ratio is lower. The trade demands more discipline. Risk-reward ratio, 1.66. That is not enough for careless execution. Now trader type again. An aggressive trader may tighten the stop above the February 5th key low. The ratio improves. The position size can increase. Sometimes that works. But near a key low, wicks can be violent. Price can dip. Price can shake. Price can touch the tight stop. Then it can return. The idea survives. The position dies. A conservative trader uses the key low as the real failure line. The position size becomes smaller. The trade gets room. But if the wider stop reduces the reward too much, no trade becomes the better answer. Here, the ratio is 1.66. The trade is possible, but not comfortable, so the entry must be precise. Now management. If price reaches June 9th U.S. lower boundary, protect. That line can reject. It can turn from target into resistance. If price holds above it and builds distance, then a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop must follow structure. Not the last green candle. Not the feeling that the bottom is in. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now the final read. June 9th US forms between June 4th US lower memory and June 5th US upper memory. It compresses. It overlaps. Price tests June 5th US lower boundary. It reacts. It returns toward June 9th US lower boundary. Long setup. Entry. June 5th US lower boundary. Stop. February 5th key low. Target. June 9th US lower boundary. Risk-reward ratio 1.66. The setup is not a full reversal. It is a lower memory bounce. If the lower memory holds, the trade can work. If the key low fails, the trade is wrong. If the entry becomes late, no trade. If the target gets too close, no trade. If the risk-reward breaks, no trade. Today's chart needs the higher time frame. If the movement feels confusing, go back to monthly, weekly, and daily, especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. Price reaches. It reacts. It holds or fails. And the trade only happens when the risk deserves the reward. Price drops first. But the lower memory does not break. The session forms below compressed pressure. Before any trade, the higher time frame comes first. Do not enter the 1-hour chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading near major pressure. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels are not background. They are the field. If price moves near those areas, 1-hour movement can look clean and still trap you. A breakdown can look strong and still hit old lower memory. A bounce can look strong and still fail at the next session line. A long can work only after the lower memory survives. A short can work only after recovery fails. That is why the session line matters. Now look at June 9th Asia session. June 9th Asia session forms below June 9th US session box. It forms compressed. It overlaps under that pressure. The session forms at the boundary of lower acceptance and old resistance. That matters. When a session forms below another session box, price is not in free recovery. It is still trading under pressure. But when the box is compressed, the decision comes faster. There is less room to hide. Moves stall earlier. Pullbacks deepen faster. Reaction comes sooner. Continuation fails earlier. June 9th Asia session first moves lower. It reaches June 5th US session lower boundary. It tests that lower memory. Then price moves up. It reaches June 9th Asia session lower boundary. It tests the underside of its own compressed box. That movement creates two trades. Short first, then long. But only if the lines survive. We build the first trade in the correct order. Stop line first. Entry line second. Target line third. Most traders start with entry. They see price moving down. They want to short. But if the stop cannot be placed correctly, the trade already fails. If the target does not pay enough, the entry does not deserve action. So the short starts with risk. June 9th Asia short setup. Entry line. June 9th Asia session lower boundary. Stop loss line. June 9th US session lower boundary. Take profit line. June 5th US session lower boundary. Risk-reward ratio 1.94. The entry sits at June 9th Asia session lower boundary. Why there? Because price is trading under the June 9th U.S. session box. The Asia box forms below it. If price reaches the Asia lower boundary and cannot reclaim above it, sellers keep control. The lower boundary becomes the sell decision. The short is not chasing the lowest candle. The short is taken when price fails to return above the compressed session line. Price reaches the line. It cannot stay above. Distance does not open upward. Reaction comes back. Then the short becomes active. The stop sits at June 9th U.S. session, lower boundary. That stop protects the real failure point. The short works while price stays below the stronger U.S. session memory. If price recovers into the June 9th U.S. lower boundary and holds there, the short pressure changes. The market has reclaimed the line that was supposed to reject it. The short loses control. So the stop belongs there. Not too close to the candle. Not too far away from the structure. At the line where the idea breaks. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at June 5th U.S. session lower boundary. Why there? Because price is dropping toward old lower memory. The target is not chosen because it looks far. It is chosen because price has a reason to react there. June 5th U.S. lower boundary already worked as lower memory. If price reaches that area, buyers can appear. Shorts can cover. Reaction can speed up. So the target belongs there. Risk-reward ratio is 1.94. That is tradable. But it still requires clean execution. If entry is late after price already falls away from June 9th Asia lower boundary, the ratio weakens. If the stop is widened beyond June 9th U.S. lower boundary without reason, the ratio weakens. If the target is pushed lower before price earns distance, the trade becomes hope. The short must be taken at the failure line. Not after the easy distance is gone. Now price reaches June 5th U.S. lower boundary. It reacts. It cannot keep falling cleanly. The distance becomes shorter. Reaction starts coming upward. Now the same target becomes the next decision. This is where traders freeze. They just took a short. They want the market to keep falling. But the structure changes. The target has been reached. Lower memory appears. The next trade can become long, but only if the lower memory holds. Now build the second trade. Long setup after the short target. Entry line. June 5th U.S. session lower boundary. Stop loss line. February 5th key low. Take profit line. June 9th Asia session upper boundary. Trailing target. June 9th U.S. session upper boundary. Risk-reward ratio. 2.32 after trailing. The entry sits at June 5th U.S. lower boundary. Why there? Because that line is the lower memory that stopped the short. The market reached it. It reacted. It did not continue cleanly lower. The long begins only after that lower memory survives. The entry is not a random bottom pick. The entry is the reaction from old memory. Price reaches. It holds. It returns upward. Then the long becomes active. The stop sits at February 5th key low. That line matters. It is not just another intraday line. It is a major higher time frame memory. The weekly chart already marked it. Price has already reacted around it. If price loses the February 5th key low, the long is damaged at a larger level. The trade no longer has a base. A tighter stop may make the ratio look better, but it may not protect the actual idea. Near a key low, wicks can be violent. Price can dip. Price can shake. Price can remove a tight stop. Then it can bounce. A conservative stop respects the real failure line. That line is February 5th key low. The first target sits at June 9th Asia session upper boundary. Why there? Because price is moving back through the Asia box after lower memory holds. The upper boundary becomes the first full return target. If price reaches that area and stalls, protect. Do not assume full reversal. The market is still inside higher timeframe pressure, but the move earns more distance. Then the trailing target can extend toward June 9th U.S. session upper boundary. That is where the trade grows from a lower memory bounce into a larger session return. The trail is not random. Price must first earn the move. It must reclaim distance. It must keep reaction from getting too fast. If price reaches the first target and still holds, the next memory becomes available. June 9th U.S. upper boundary becomes the trailing target. Risk-reward ratio becomes 2.32. That is the stronger payoff. But the trail must protect profit. A target that moves without a stop is only hope. When the target moves, the stop must follow. The trailing gap should not be too tight. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. If the stop is too tight, normal reaction can touch it. Then the trader exits before the real target. If the stop is too loose, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. If the trade reaches multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not create edge. The edge comes from the line. The edge comes from short failure at the target. The edge comes from lower memory holding. June 9th, Asia gives the lesson. Short from the lower boundary failure. Long from the old lower memory hold. The trader must not marry direction. Direction changes. Structure decides. Price reaches. It reacts. It fails or holds. Then the trade begins. Price rises into pressure. But the upper side cannot stay clean. The session forms around overlapping memory. Before reading June 10th U.S. session, keep the higher time frame visible. The weekly chart is still active. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. Weekly 0.33. Weekly 0.25. February 5th key low. The falling trend line. The rising trend line. Those levels still shape the 1-hour chart. The market has bounced from lower memory, but a bounce does not erase the field. A recovery can move up. Then it can stall. Then it can return lower. That is why we do not chase the middle. Now look at June 10th U.S. session. June 10th U.S. session forms between June 5th U.S. session midpoint and June 4th U.S. session lower boundary. It fully contains the June 9th Asia session box. It overlaps that memory. The session forms inside a larger decision area. That matters. When a new session contains the prior Asia box, price is no longer dealing with one small line. The new session absorbs the old range. The market is building around the same battle. Old lower memory. New upper boundary. Prior Asia structure. The box becomes the working field. A contained box can create traps. Price can move above the prior small structure and still fail inside the larger session. Price can move below the prior small structure and still react inside the larger session. So the trader must focus on the working boundary, not the middle. After the session forms, price moves higher. It tests June 9th U.S. session upper boundary. It reaches the upper memory. Then price begins to fail. It moves lower. It tries to test June 10th U.S. session lower boundary. The movement is simple. Reach upper memory. Fail to stay. Return toward lower memory. That is the short setup. Now build the trade in the correct order. Stop line first. Entry line second. Target line third. June 10th U.S. short setup. Entry line. June 10th U.S. session upper boundary. Stop loss line. June 10th U.S. session upper boundary, 150% area. Take profit line. June 9th Asia session lower boundary. Risk-reward ratio, 1.63. The entry sits at June 10th U.S. session upper boundary. Why there? Because price is testing the top of the active session. If price reaches the upper boundary and holds above it, the short has no reason. If price reaches the upper boundary and fails to stay, the recovery loses pressure. That failure becomes the short. The short does not start because price is red. It starts because price cannot hold the active upper boundary. Price reaches. It reacts. It cannot stay. Distance does not open upward. Continuation fails earlier. Reaction comes back faster. Then the short becomes active. The stop sits at the June 10th U.S. upper boundary 150% area. That stop is shallow. That creates risk. A shallow stop can improve the ratio. It can also get hit by normal reaction. So this setup is not for careless entry. The stop only makes sense because the target is close enough and the ratio still pays above the filter. Risk-reward ratio is 1.63. It is above 1.5. But not by much. The entry must be clean. The stop must match the failure logic. The target must be close enough to pay before the market turns. If the trader enters late, the ratio weakens. If the trader widens the stop, the ratio can disappear. If the trader hesitates after the upper boundary failure, the trade becomes worse. So this short needs precision. The target sits at June 9th Asia session lower boundary. Why there? Because the June 10th U.S. session contains the June 9th Asia box. The lower side of that Asia memory becomes the next target. If price fails from the June 10th U.S. upper boundary, it can return into the contained Asia memory. The first clean destination is June 9th Asia lower boundary. That is why the target is not far away. The target is close. But the risk is also shallow. The trade can be attempted because the nearby target still gives more than 1.5. This is a tight execution trade, not a wide trend trade. Now consider the alternative. If the stop is not shallow, if the stop is placed at June 4th U.S. session midpoint, or if the stop is placed at June 8th U.S. session lower boundary, then the trade changes. The stop becomes deeper. The position size must become smaller. The target must also move farther. If the stop moves deeper, the target must be at least June 5th U.S. session lower boundary or beyond. Otherwise, the risk-reward fails. That is the key. A conservative stop needs a larger target. A tight target cannot pay a wide stop. Many traders lose here. They want conservative stop protection, but they keep the same close target. Then the ratio collapses. The trade looks safe, but the math fails. If the stop is wide, the target must expand. If the target cannot expand, no trade. That is the filter. Now watch the behavior. Price rises into June 10th U.S. upper boundary. It cannot hold. The move stalls. Pullbacks deepen. Bodies stop expanding. Reaction speeds up. Then price rotates down. The short is not emotional. It is the response to failed holding. If price had held above the upper boundary, no short. If price had reclaimed and stayed above the 150% stop area, no short. If price had already moved too close to June 9th Asia lower boundary, no short. The trade only exists when the upper failure still leaves enough distance to the target. Risk-reward ratio, 1.63. That number controls the decision. Now trader type matters. An aggressive trader may accept the shallow stop. The stop is tight. Position size can become larger. The target is close. The move can pay fast. But the risk is clear. A wick can remove the position. A small push above the upper boundary can hit the stop. Then price can still return lower. The idea may be right. The position may be gone. So an aggressive trader must accept that pain. A conservative trader may use a deeper stop. June 4th U.S. midpoint. Or June 8th U.S. lower boundary. That gives the trade more room. But the position size must be smaller. And the target must move lower. At least June 5th U.S. lower boundary or beyond. If that target is not realistic, the conservative trader should skip. This is how both traders can use the same structure differently. Aggressive trade. Tighter stop. Closer target. Higher size. More stop-out risk. Conservative trade. Wider stop. Farther target. Lower size. More survival. But both need risk-reward. Without reward, no trade. Now management. If price reaches June 9th Asia lower boundary, protect. Do not assume the breakdown continues. That line can react. It is prior Asia lower memory. If price reaches it and stalls, take the result. If price breaks it and holds below it, then a trail can be studied. But the trail must be earned. A practical trailing interval needs about 0.5 risk-reward unit or more. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop must follow structure. Not the last red candle. Not the feeling that sellers are in control. If price cannot keep distance, protect more. If price keeps distance, let the remaining position work. Partial profit can help. A conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the split does not matter if the entry is wrong. The structure comes first. Now the final read. June 10th U.S. session forms between June 5th U.S. midpoint and June 4th U.S. lower boundary. It contains June 9th Asia session box. Price rises to June 9th U.S. upper boundary. Then it fails. Short setup. Entry. June 10th U.S. upper boundary. Stop. June 10th U.S. upper boundary. 150% area. Target. June 9th Asia lower boundary. Risk-reward ratio. 1.63. The trade is possible because the stop is shallow and the target is close. But the risk is also real. If the stop is widened, the target must move lower. If the target cannot move lower, no trade. Today's chart needs the higher time frame. If the movement feels confusing, go back to monthly, weekly, and daily, especially weekly. The 1-hour chart shows the fight. The weekly chart shows the field. Price reaches. It reacts. It holds or fails. And the trade only happens when the risk deserves the reward.